thinking about investing but don't know where to start? You're in the right place. Welcome to our beginner's guide on how to invest in stocks. In this series, we'll break it down into simple, easy to understand steps. Let's get started with part 1. First things first, step 1, set your financial goals. Why do you want to invest? Is it for retirement in 30 years? A down payment on a house in 5 years? Or maybe just to grow your wealth over the long term? Your goals will determine your investment strategy. A long-term goal, like retirement, allows you to take on a bit more risk for potentially higher returns. A short-term goal might mean you need to be more conservative because you'll need that money soon. So, take a moment, grab a notebook, and write down what you're investing for and your timeline. This is your roadmap, and it's super important. All right, step 2. Let's learn the lingo. Investing can sound like a foreign language, but the basics are pretty simple. First up, what is a stock? When you buy a stock, also called an equity, you're buying a small piece of ownership in a publicly traded company. So if you buy a share of Apple, you literally own a tiny fraction of Apple. Pretty cool, right? Next, you'll hear the term dividends. A dividend is a portion of a company's profits that it shares with its shareholders. Not all companies pay dividends, but when they do, it's like getting a little bonus just for owning the stock. It's a way for companies to reward their investors. You can either take this as cash or reinvest it to buy more shares. Then there's market capitalization, or market cap. This is just a fancy term for the total value of a company. You calculate it by multiplying the company's stock price by the number of shares it has. Companies are often categorized by their market cap: large cap, mid cap, and small cap. Large cap companies are the big, well-established players you've heard of, like Microsoft or Amazon. They're generally considered safer investments. Small cap companies are younger and have more room to grow, but they also come with more risk. Another key term is the P/E ratio, which stands for price to earnings ratio. This helps you understand if a stock is overvalued or undervalued. It compares the company's stock price to its earnings per share. A high P/E ratio might suggest that investors expect high future growth, while a low P/E could mean the stock is undervalued or the company is facing challenges. It's a handy tool for comparison, but it's just one piece of the puzzle. You'll hear about bull and bear markets. A bull market is when the stock market is on the rise and investor confidence is high. Everyone's optimistic, and prices are generally going up. Think of a bull charging forward. A bear market is the opposite. It's when the market is declining and pessimism is widespread. Think of a bear hibernating or swiping downwards. The market always moves in cycles, so understanding these trends helps you keep your emotions in check. Now that you've got some vocabulary down, let's move to step 3. Open a brokerage account. You can't just go to a store and buy stocks. You need a special account with a brokerage firm. These are the companies that act as a middleman between you and the stock market. There are tons of options out there, like Fidelity, Charles Schwab, or online platforms like Robinhood and Webull. When choosing one, look at things like fees, minimum investment amounts, research tools, and customer service. Many brokers now offer zero commission trades, which is fantastic for new investors. Do a little research, compare a few, and pick one that feels right for you. Opening an account is usually a straightforward online process, similar to opening a bank account. And that brings us to our final point for today, step 4. Start with a budget. You absolutely do not need to be rich to start investing. The key is to start with an amount you're comfortable losing. I know that sounds scary, but investing always carries risk. Never invest money you need for essential expenses like rent or bills. Start small. Even $50 or $100 a month is a great way to begin. Many brokers let you buy fractional shares, meaning you can buy a slice of an expensive stock without having to afford the whole share. The most important thing is to be consistent. Investing small amounts regularly, a strategy called dollar cost averaging, can build significant wealth over time. So, to recap, set your goals, learn the basic terms, open a brokerage account, and set a budget. That's your foundation. In our next video, we'll dive into how to choose your first stocks and different investment strategies. Make sure you subscribe and hit that notification bell so you don't miss part 2. Thanks for watching, and we'll see you in the next one.